Housing prices, oh my God, they have been off the charts. People are buying houses sight unseen. The question is that irrational or is it rational? Or are we setting ourselves up for another 2008 crash? Welcome to this episode, the Affluent Entrepreneur Show. We're going to talk about those and other things about the housing market in this episode. I can't wait to see you in the episode. All right, welcome to this episode of the Affluent Entrepreneur Show. Here's the deal. So many people are coming to me and saying, I want to buy real estate. What should I do? But I'm afraid that we're in a bubble. What's going to happen? I mean, let's face it. The median house price is up in the fourth quarter of 2021. The median house price is up over $400,000, $408,100. Crazy, okay? But here's the thing. They're thinking, a lot of people are saying, are we in another 2008? Is it going to crash? 2008 was a very unique set of circumstances. So I want to kind of walk through a little bit of this so you understand it and kind of tell you what I think you need to consider if you're thinking about buying a house or selling a house or doing anything in here. But let's just look at where we were before. In 2008, they were doing something called ninja loans, okay? No income, no documentation, no job, okay? And it's like they were handing money out to people that were probably overbuying, overextending themselves, and unqualified. And lending was completely laxed during that time. And what they were doing is they were creating what they call subprimes with low variable teaser rates. So what they were doing is sitting back saying, we're going to give you a rate at 2% or 1%, but it's variable. So unlike what's going on today, where we had 2.5%, 3% mortgages, which were fixed for the life of the loan, these were variable and they were fixed maybe for 3 years or 5 years, and then they would start to adjust. So they lowered the interest rate temporarily to allow someone to get in the loan that probably shouldn't be in that loan back in those days. And they were also having people go in with low down. So they weren't asking for 20% down. So there was very little equity. So if you have an overpriced, think about the thing that happens here. You have an overpriced market. You don't put much money down. You get into a loan that is an adjustable low rate teaser rate that you can get into. So you can afford it for now, but you can't afford it for long unless your income goes up. And now the lender's answer to that is, well, down the road, just refinance and you'll be okay. Yeah, but we don't know what the conditions are when the refinancing was. And in fact, down the road, you couldn't refinance because they couldn't qualify because the rates were higher and their jobs were in jeopardy because we had the recession. It was a problem. And so what happened? Went into foreclosure. Buyers were upside down in their loans in 2008. And there's this whole other aspect of it where they packaged these loans up and sold them as mortgage-backed securities. And there was a whole debacle with that, okay? I don't see that going on today. And so could we have a similar result as 2008? Maybe, but we certainly won't have the similar cause. There's other things that are going on. Think about where we are today and why the demands are where they are today. One is that we've put a forbearance because of the pandemic and a foreclosure moratorium on many homeowners, so they didn't have to pay their mortgages. You couldn't evict someone if they weren't paying rent. And so there was this artificial security that was given to the real estate world, much to the chagrin of landlords. They couldn't even they couldn't deal with people that were non-paying tenants in there. We have low interest rates, or at least had low interest rates, but they've hit closer to 4% now. But interest rates, it was not unheard of to get a fixed rate in the twos. I mean, that's giving away money. I remember when I bought my first house, now it was a few years ago, but our rate on our mortgage was 9%. 9%. Okay. And I thought that was a good rate. But now you can get 2.5 to 3.5, but it's crept up because the feds are increasing rates, so they're going to creep up. We've got low inventory now. It's just the home building has stalled out. There isn't a lot of homes for sale. There's a lot of people trying to move. Heck, in California, everyone's trying to get out of California, and I get it. So there's low inventory. So low inventory, you got to look at all these circumstances, start to create an environment, the feeding frenzy on the buying of the homes. You couldn't get materials because of the supply chain issues. So lumber was going up, labor availability was low. So all this stuff combined to create an environment where people were just trying to grab whatever they could. It's a feeding frenzy on buying homes. And so what was happening is people were buying homes based on emotion and saying, I got to get in quick because tomorrow it's going to go way up. Okay, now, if you listen to me at all, if you watched me at all, when we make emotional financial decisions, our financial intellect goes down. The typical thing is that if we make an emotional financial decision, it is going to go against us because we haven't thought it through. If someone wants to buy a home, sight unseen, no appraisal, no inspection, they are bearing a huge risk. And they get into a home that's priced high in the market. They get in with not a lot down. So if it goes against them, they have negative equity. And if they get in the home that wasn't inspected, they had no appraisal, and now they find out they have a foundation problem, they bought themselves a black hole of cash, okay, a money pit. And so it's the thing that I think we need to consider, but where we got here is because of all the circumstances that converged at the same time of the low inventory, the low interest rates, the forbearances, the low labor, the high materials. But where are we and where are we going? We have to look at what's ahead of us. And what's ahead of us is clear. We have inflation is one of the biggest things. And inflation, as much as they originally said, well, it's transitory. Well, it's not transitory because transitory would mean that things would settle back into its old place, the old pricing. I was driving to the gym this morning and looking, gas prices here in California are approaching $7 a gallon. Good news, I drive an electric car. Okay. But the reality is that how can people afford that? Just the cost of living. So we're in an inflationary time, which we were not in previously. We had very low inflation, 2%, 3% max. Interest rates are now going to increase. The Fed's raised the rate once already. They've insinuated and said that they'll probably raise it 6 more times. Powell has also mentioned that there might be more aggressive rate moves versus just 25 basis points or a quarter point. They might go faster or harder depending on what needs to happen. So an interest rate increase will increase the mortgage rates for buying. And now here's the challenge is people start to think, well, the price is getting away from me. Interest rates are getting away from me. I got to rush in. And they make a bad buying decision in that situation. Look, an increase in the rate can give you 15 to 20% higher payments. And I get it. But then we got to look at the math behind it. We got to do it right. Remember that median house price is over $400,000. So what we need to consider is this. There are homes for sale and people are moving because they have taken this time during this time of the pandemic to reflect and start asking themselves, what do we really want in life? What really matters? Do we want to own real estate? Do we not want to own real estate? Do we want to live here? Do we not want to live here? Whatever forbearances and moratoriums were in place, they're going away. Those people that have student loans that haven't been paying on because there was a forbearance moratorium on it too, it's coming back in May, unless they kick the can down the road. But this is something that is going to come home to roost. You cannot ignore it. And what will also impact our future is the availability of jobs and the affordability of living. And if over time the Fed keeps increasing rates and pushes us into a recession, which is a possibility, I'm not saying it's probable, but it's a possibility, and you need to think about it, is that you potentially now have a situation where the job's in jeopardy, your income flow is in jeopardy, your affordability is swayed. So it becomes important that if you're going to buy anything or look at the real estate market, to look at it through those eyes. And I'm not saying not to buy. I'm simply saying to buy right. And you might look at it. I got a client of mine that was bidding on a house. They said they put a bid in and they made it to the top 8 bidders for a house. Now, first off, when you're in a bidding frenzy, it's the wrong place to be. Okay. Now, I get it. A home purchase is an emotional purchase, and you have to be careful about those emotions getting in the game. Well, they lost out on the house, and the person that won it was multiple 6 figures above their bid. Multiple 6 figures, like $300,000 to $500,000 more. It's crazy what people are willing to do. Now, let's assume that they bought this house, and it was an expensive house, but let's say they bought this house at $1.5 million, and then there's a recession and the market cools down. It's now only worth $1.2 million. But they bought it at $1.5 million, and they put a lot of loan against it, and now they have zero equity because the loan against it's $1.3 million. You've got to be thinking through it in that way. Now, the other reason why I don't think a 2008 is coming is that most of the loans these days that have been done are fixed rate loans. They're not variable adjustable rate loans like they were in 2008, where people were going to get caught when the rates adjusted. So as long as you get into a fixed rate loan, you know that that's the payment for the rest of the life of the loan, and it won't change. They can't change that. And if you can afford the payment now, then you just need to make sure you can afford it on an ongoing basis. They are also a bit tighter on the documentation. They're not doing the loose documentation or no documentation types of loans that they were doing back before the 2008 mess up came in place. So I think it's important to understand that there's a very different time. Now, there is circumstances that can impact it and certainly bring that market down with everything that could go on. But it's not the same circumstances that we had in 2008. If there's a bubble, it's not the same bubble that was in 2008. So what should you do? Well, I think there's first things first is to understand, number one, that buying a home is a long-term decision. It truly is. If you do not believe for you that you're going to be in that home for a minimum of 5 years, I wouldn't make a purchasing decision. Or if you believe that there's going to be a life change, say you're going to get married. And I'll give you a for instance. Okay. I had a home now. I bought it years before I met Stephanie. Okay. Stephanie and I will be married 11 years this year. And, but I bought this house that we were living in, Jeremy and I were living in, years and years ago. And she came into my life, and and we're living in that house. But she never really felt it was hers because we didn't do it together. Now the house we're in is ours. And so I think you need to be aware of, are there life changes that are going to come about for you that might beg the possibility of a home change, or are there job changes that might come into play that may require a location change? Those things need to be considered because a home purchase, it's costly to get in because of all the costs. It's costly to get out because of all the costs. And so they're not short-term decisions. So I look at it and say minimum 5 to 7 years, 5 years minimum. Okay. So that's number one. Number two, do not overbuy. which also means that you've got to look at your income and start to understand, where's my income coming from? How stable and secure is it? And am I going to have increases in income? Do I have bonuses coming in? And look at where you are and do not overbuy. I tell people I don't want your housing costs to be much more than 25 to 30% of your income. And when I say housing costs, that means your mortgage, your insurance, your taxes, your utilities, all of it. Okay? If we go beyond that, you start putting yourself at risk. If all of a sudden your 50% of your income is going towards housing, how are you living? Because we got taxes in there somewhere. And if it's forcing you to put things on credit cards, we do not finance lifestyle with credit cards. That's another sinkhole. So that's number 2, don't overbuy. Number 3, do not get caught in the frenzy. If there's a whole bunch of folks that are going after the home, and do not get caught in the emotion or the frenzy of bidding and saying, I just want to win. Because that's your ego making a decision, and a buying decision you can't afford. Okay? Let it go. In fact, when I do negotiating, either for myself or when I go in to consult on a negotiation, which I do a lot and I assist in negotiations, the first thing I want to know is to set up, and this happens with stock investments anytime we're going into a deal. Stock, investing, real estate, I want to know my exit before I get in. I want you to know your exit, the line you will not cross. You will not cross. So you sit back and say, this house looks good on based on the numbers and the things that I want to do at this number, and I'm willing to go from I don't know, 400,000 to 430,000. If it goes a dime over 430,000, I walk away. You have to have a line. If you keep moving the line, they will push you and push you and push you, and all of a sudden you overbuy. You get caught in the frenzy. Know your exit point. Know your walkaway point to make that happen. Now, that leads me to number 4. I actually prefer 15 to 20-year mortgages, especially if you're up in years. Okay. Now, I will tell you, given the current rate environment, and I proved it out, I did an episode on this, that given the low interest rate environment, it may make sense to actually go to a 30-year mortgage and invest the difference between what you would pay on a 15 or 20 year and you pay on a 30 year. So I need you here to look at this and say, to do the math and say, what would it cost me? Is there a big differential in interest rate between a 30 or a 15 and a 20? What's the difference in payment? And will I be disciplined enough to invest the difference between that 20-year mortgage and that 30-year mortgage, say? So if the 30-year mortgage payment is $800 a month and the 20-year mortgage payment is $1,000 a month, you get the $800 a month mortgage and you invest the $200. And the beauty behind that is, once you get 15 years in, if you want to pay the mortgage off early, you can, because you have the investing in place. We don't use it to fund lifestyle. Too often we get into the 30-year mortgage so we can spend more on lifestyle. Use it to build your money machine. Okay. And number 5, as I said before, no more than 30% on your gross of your income goes to housing. No more than 30%. And number 6, I want you to look at your total debt. Okay. Total debt needs to be less than 35%. That means you got to look at car debt. You got to look at student loan debt. You got to look at credit card debt. And then you got to look at mortgage debt. If I add my mortgage debt to my credit card, my student loan, and my other consumer debt, it should not be more than 35% of your total income. That means if it's over 35% of your total income, you got to go to a smaller house. So you got to get some of that debt paid off. And all I'm trying to do is give you breathing room should the market flatten out or come down, so you can sustain yourself and that you don't lose a home in foreclosure because you can't afford it anymore. Okay. And so it's important to look at it that way. So those are the things that I would do if I was looking at a house in today's environment and working from that. So I hope this helps you. I hope you get a chance to look at this. Listen, I get it. A home sometimes is a dream for a lot of people. Let's just get into it the right way. Let's get into it the smart way. Let's get into it so we can stay in it long term and make it the home that it was meant to be and not a nightmare. Okay. And so these are the things that I would do to make that happen. Now, I got a couple of other trainings for you that might help you along this journey. The first is this: how do you create a money machine? You're creating your money machine. It's episode 19. I'm going to hook that video up here. And I've got another video training about what to do with your cash. This is going to allow you to set yourself up and figure out where your cash needs to go to make sure that you set yourself up to build wealth, to take care of the things that matter, and to get to your affluence vision of financial freedom. I hope that helps. I hope I get a chance to see you on the road and soaring to financial freedom. If you've got questions or anything else comes up, do me a favor. Post a comment, send me a DM, send me a question. We'll get it out there. We'll get it answered and help you on this journey. And until we get a chance to see each other in another episode, always, always strive to live a life that outlives you. Cheers.